Hey, good afternoon, everyone. My name is Jeanmonod, Regional Vice President of Sales here at Angel Oak Mortgage Solutions. We're happy to bring to you another deep product dive webinar. Today, we'll be talking about our debt service coverage ratio program. And we'll get started here in about a minute and a half. We'll give everyone time to log in, just some housekeeping rules. This is interactive. Please use our question queue. We'll answer as many questions as we can. If we don't get to any of your some of your questions, if we don't get to some of your questions, we will have your account executive reach out to you before, the latest tomorrow morning. This is being recorded. We will get this out to you before end of day today. Just some other things at the end of our webinar. If you just take a minute to fill out a brief survey, we'd love to get some of your feedback on things we maybe could do a little better. We've been doing these webinars now for going on almost 2.5 years. We've been averaging about 2 to 2.5 a month, and you'll see some familiar faces as I'll introduce our subject matter experts here in about a minute. So a lot of people logging in. Hopefully everyone's New Year is off to a great start. I'm actually playing an away game today. Down in our Miami office. We were at the FAMP Miami chapter trade show yesterday afternoon. Great turnout. We had a breakout session, a lot of great questions. So hopefully we'll get those great questions again from you guys here today. So give it about another 30 seconds. All right. Well, let's get started. A couple minutes past the top of the hour. My name is Jeanmonod, Regional VP of Sales here at Angel Oak Mortgage Solutions. Thank you all for taking the next, 50 plus minutes out of your day to learn more about our debt service coverage ratio. And to bring you this great content today, we have Lisa Lee, our account executive from Utah. Lisa, please introduce yourself. Tell us a little bit about yourself.
Lisa Lee from Salt Lake City, Utah. I'm a native of Utah, and so I've been here my whole life and love the outdoors, shoot guns, hunt, hang out with kids, be outside in the snow or the heat in the deserts. And I've been in this industry a really long time and been with Angel Oak for over 5 years now. So I work with the best team in the country. So excited to be with you guys today.
Thank you, Lisa. And then here across the hall from me today is Oscar Ungo. Oscar's one of our best inside sales guys. Oscar, please introduce yourself.
Hey everybody, good morning, good afternoon to some of you. My name's Oscar. I've been with the company for 5 years now. And this is one of my favorite programs. This webinar is really exciting. This is one of the top performing programs in the industry, in the market today. So I'm really, really excited to get started.
Yeah. Well, thank you, Oscar. Thank you, Lisa, for taking the time out of your day. These are our subject matter experts. They don't get better than these guys. So today we're going to do a deep dive into our debt service coverage. As I mentioned, we're going to talk about what that loan application needs to look like, and then what the credit needs to look like. And we're going to do a highlight of our programs. We're going to talk to you about great tools we have on our website. We're going to talk about great marketing tools that we have on our website. So everything's driven from our website. This is being recorded. We will get this out to you before end of day today. But before we jump into our debt service coverage ratio, we're going to launch a poll here. And that poll question is, who has originated a debt service coverage ratio in the last 12 months? So we'll get started. Just a couple of, and Oscar mentioned this a little bit before the call. A lot of our debt service coverage ratio borrowers are self-employed, and that self-employed segment of the workforce continues to grow year over year, and that's 20% increases year over year. So we're going to tell you where to find these borrowers today too. So let's see the results of our polls. Wow, this is huge opportunity, Lisa and Oscar here. 84% of you have not originated a debt service coverage ratio loan in the last 12 months. 14% of you have. That's why a large percentage of you are on here, not only to learn about this program, but to even learn more about this program. So thank you for joining us. We're going to get Lisa. Lisa's going to cover the highlights of our debt service program. And again, everything's run off our website. We call it internally our investor cash flow, but the industry knows it as a debt service coverage ratio. So Lisa, take us away with the highlights, please.
Okay, yeah, so the investor cash flow is our version of the debt service coverage ratio product that's out there. There are a lot of lenders out there offering this now, so I'm sure you've at least heard of the debt service coverage ratio product that's out there. It's a huge door opener, to get into places that you haven't been into before, but to walk in for new marketing, it's just such a great opportunity, as they said. So we'll talk about that later. But so our product, actually, it's for your first time investors, looking to purchase their first investment, or if they have multiple properties already, this is a great product for those guys too. We allow them to have unlimited properties that are financed. So that's a plus on this product. It's a debt service coverage ratio. So of course, we're looking at scores at 680 and above. We go to 80% loan to value on our program. Our calculation currently, our debt service coverage is, and basically one of my colleagues explained it well. So we have to ATR these loans just like anything, any other loan. And so instead of looking at a debt to income ratio or calculating that, we're actually going to calculate the debt service coverage ratio, right? So that's how we ATR these loans, or get the ability to repay or show that. And so and how you calculate that is basically the rents divided by the new total payment, or the PITI-A payment, including association dues. Ours is currently at 1.15. And what that means to you, or in blonde terms, I'll say, is the rents need to be at least 15% higher than our new total payment to qualify at 80% with no hits. Now, so for a quick example, if the new total payment is $1,000, then of course we're going to hope that those rents come in at least $1,150 or higher to qualify at 80% no hits, right? Now we do offer, which this is great, but we will offer or allow the debt coverage ratio to go down to 0.80. So right, of course that allows it to be negative 20% from our new payment. There are hits though, so you'd have to limit your LTV to 70% on purchase rate and term, 60 on cash out, and there's a rate hit. But it saves that deal. So of course, then just a quick example again. So the $1,000 payment, we would allow the rents to be down to to 800, and that would still qualify at those lower LTVs, right? So that's kind of what it looks like and how we look at the calculations on it. On rate and term, on refinances, you can actually use rents with 3 months payments versus the 1007, and the 1007 is where we pull these rents from to do the calculation. Please keep in mind, don't submit rents or rental agreements on ours, as we cannot unsee rental. So unless you're completely confident that that will qualify this, advise your processors and yourself never to submit a rental agreement on these. So let me skip on here. So we allow these to be closed in LLCs, right? Our requirement for LLCs are that they have max 2 partners. They all must qualify on the loan, and so it shows on their credit, everything else. Now there's no seasoning on the LLC, so they can actually create a new LLC for this particular property. So in case they have others out there with more partners, whatever, that's fine. They can create a new one. So that helps a little bit there. Again, I already mentioned that we allow them to have unlimited properties. So, if they're a mass investor already and have properties, this is a great product for those guys too. This is a dead stop for us. They must own a primary residence. I know, believe it or not, especially in desperate times, people get creative with their occupancy. This is important that we make sure that these are actually investment properties. This is a business purpose loan. It has a lot of different features on it than primary residence. So we do require that. It's allowed on purchase, cash out, rate and term, for any of these investors. Another just quick note, we do want to make sure that they're removed from the MLS, or the market before our application date. We've run into a lot of situations recently that people are like, okay, well, I'll refinance, but I'll list it too. So I'm going to list it or refi, whichever comes first. Well, it's not very comfortable for a lender actually looking for payments. So anyway, we do need to make sure of that. All of our rates are 30-year fixed. So 30-year fixed, we do actually also offer a 30-year interest only, which is basically a 10-year IO period, and then it converts to a 20-year fixed afterwards. Keep in mind though, that the payment for the debt service calculation is calculated on a 20-year fully amortized payment. So it can get a little tight and may, you know, you may have to switch it back to just a regular fixed. But the bottom one is irrelevant. So our max loan size on this is 1.5 million. So two exciting things that we just found out this week, 2 days ago, which we're all super, super, super excited about, is they just brought back our non-warrantable condominiums. That's huge because we allow 100% investor concentration and some other quirky things that would not be allowed ordinarily, right? And so that's super exciting, especially in Oscar's world, and mine too. We have little that too.
Right,
And
Park Cities, right?
Right
yeah,
there.
right there. And also we allow short-term rentals, they're back. So keep in mind on the short-term rentals, this is a VRBO, Airbnb, that sort of situation. It cannot be a condotel. So if you Google this and it says hotel on it, or they can actually book a room at the same site, it's probably going to be turned down. But for, you know, for those nightly rentals, this is exciting that we can do these again. We're going to look at the rents from the 1007. So the annualized rents, but we will allow the short-term rentals. So that's a great addition. We are expecting to see more and more enhancements that are coming, but this is what we've heard so far. We've been trying to squeeze it out of them, but this is what we have today. So anyway, I'm going to turn it over to Oscar to talk about the 1003 because that's an important part about this deal. So
Yeah, Lisa, you knocked out a good amount of questions here. So I think Anton's was about how do we calculate the term for the rent, the 1007 or whatever. But, and then this is being, Joshua, this is being recorded. We will get this out to you before the day today. We are going to get to your questions. As I mentioned earlier, we're going to talk, I mean, you should be, Oscar and Lisa have 5 years experience apiece, but when we're done today, you should be really well educated on almost an account executive level on what we want to see. So Oscar is going to go into the 1003. And Oscar, tell us what are the most important parts of the 1003 we want to see, and probably more importantly, what we don't want to see.
Absolutely. And yeah, by the end of this call, you should all be able to communicate to your clients intelligently and your referral partners how you can pre-qualify customers using the debt service coverage ratio program. So first, we're going to be covering the 1003. The 1003, as one of my colleagues says, is the DNA of the loan. And the great thing about putting together an application on a debt service coverage ratio loan is that you're actually going to put in less information. It's going to save you time than you would on a traditional loan. So are we going to pull up a 1003, or am I just going to be?
No, just going to talk about the key pieces of it. Sorry.
So,
yeah.
Key things, a really exciting thing. Lisa mentioned no DTI. So you're not going to be adding any income or employment information to the 1003 at all, right? So that is one thing off of your checklist. The next piece, you are going to have assets. We want to see assets. We do require 6 months reserves on the subject property only. We want to see the cash to close, etc. So assets do have to be on there. Sometimes liabilities are imported already on your application once you're exporting it. So that's perfectly fine. We're not going to be looking at DTI. We won't be looking at those liabilities. If your client has any other real estate, then you want to make sure to have that section complete. If those properties are business purpose loans, so they're non-recourse, meaning that the loan and title are in the business's name, then you do not need to add them to that application. And so essentially everything on the 1003 except for income and employment should be complete. And the reason behind all that, you know, there is a method to the madness, is that you're going to be working alongside with your account executive. Lisa and I, or whoever your assigned account executive is, we're going to be your second set of eyes. The way that I like to explain it is that when you are taking a traditional application, let's say it's Fannie or Freddie, you're running DU and LP. So essentially you're sending that 1003 and credit report over to Lisa and I so that we can review the 1003 and credit report to check if your client meets the initial program requirements. And if they do, then what we're going to do next is we're going to send you our pre-approval, which is like a findings. It's going to contain all the information that you need, especially your loan submission checklist. That way you can prepare your client in order to submit your loan to underwriting and get the least amount of conditions possible.
Yeah, thank you, Oscar. And I love I love the fact that the DNA of the borrower, 30% of the loans we close don't meet our guidelines. And the way we get that is a really good loan application. Now, yes, we don't want job information, and yes, we don't want income information, but their assets, yes, we want their schedule of real estate, yes. So that's how we get, whether it's more reserves than what we require or not, that's how we get these exceptions. And with Lisa and Oscar and any of our other account executives, they're going to be the ones working on your behalf. I've also heard, AE say, the AE works with you. It's like a confessional booth. Tell them everything up front, right? We're your first line of defense, and we're going to help you position this loan and how it can close the smoothest for you, your borrower, and your referral source. So Oscar, thank you for covering the 1003. Lisa, give us a little bit what we require from a trade line perspective. And you covered this earlier, but Jack asked the question, is this loan for a first-time home buyer? So hit Jack's question first, and then hit the trade lines that we're going to require.
Sure. So credit-wise on this, as I mentioned, it's a 680 score or below. We do allow first-time home buyers, but they must own a primary residence to qualify, right? So we do want to see that. Of course, if it's paid off, that's great. We just need to know they own a primary. The one piece that we do have to look for, and it's a requirement on this loan, is mortgage history. And so people say, well, why do you need the mortgage and all this stuff? We need to make sure that they have at least 1 times 30 or less in the last 12 months on all of the mortgages. If they're, of course, reported on credit and current, that's great. That's what we need. If not, then we're going to ask for cancel checks, to show that payment history. That's what we're trying to look for. So like I say, 0 times 30 in the last, or 1 times 30 in the last 12 is allowed, or 0 times 30 in the last 12, and then they can have 2 before that. So anyway, consumer lates, we want 0 times 30 on consumer lates as well. And the trade lines is what John brought up. So we are going to look for trade lines, either 3 trade lines with 12 months history, pay history on them that have been active in the last 12 months. So they can be closed, but they have to have had some activity in the last 12 months. Or 2 trade lines with 24 months pay history shown, and then also active in the last 12 months. So that's kind of what we're looking for as far as the total trade lines, as a whole. And then 4 years from a credit event, such as BK, foreclosure, deed in lieu of, short sale, those sort of things. So, and then
Lisa mentioned this. She kind of teased a couple of things that have come out recently, like non-warrantable condos and a couple of other things. I will tell you right now, this market is stabilizing. The 2-year treasury has stabilized. In some cases, it's gone down a little bit. Liquidity is coming back into the market. So stay tuned. Stay in touch with your account executives, because there are going to be ongoing enhancements rolling out, probably fast and furious, I would say, if not daily, definitely weekly. So let's jump into a lot of the questions here. Oscar, we'll throw the first one out to you from a standpoint. John's asking if the LLC has more than 2 members. It depends on how many members. Oscar, maybe give us some questions, some answers, but also, this might fit into that exception box once in a while.
Absolutely. So if your borrower is going to be vesting title in an LLC, you want to ask them how many parties are on that LLC. We accept up to 2. And all parties on the LLC have to be on the loan. If your client does not want the other party on the loan, then we don't have a seasoning period for how long that LLC has to be open. They can go ahead and create a new LLC for real estate purposes, and then we can vest title in the LLC. The loan will be in the borrower's name, but we can vest title in the LLC. If you have a client who's looking to refinance a property and they'd like to then vest title in the LLC, make sure not to touch title if it's already in their individual name. That's something that gets done at closing, because that can trigger the clock for our seasoning period, and that's it.
And Lisa mentioned earlier, there is no seasoning on that LLC. So John, just so you know, if there are 3, 4, 5, 6 people on that LLC, you can break it off and just put 1 or 2 people on that LLC, because there is no seasoning on that LLC. So Lisa, how many, Sharon's asking, Sharon's asking, how many units will we go up to?
We do a 1 to 4 units, so just 4 max units are allowed.
And Oscar, Mark's asking, is the rent always from the appraisal?
Is the rent always from the appraisal? On a purchase, yes. On a refi, like Lisa mentioned, we can go off of the current lease agreement as long as they can provide rent receipts or the rent on the 1007.
Yeah. And Scott, do we anticipate the no DSCR coming back? You know, the odds are probably yes. Don't know what the LTV will be yet, but I do think that's going to be one of the earlier enhancements coming out. So again, stay tuned. Couple other questions. Okay, Lisa, I'm going to throw this one out to you. Javier's asking, can we do a DSCR loan in a state that the LO is not licensed in?
We actually are not set up to do that currently. So we've all been pushing for that, and we're hoping to be able to release that. There's just a lot of complications with state to state requirements and who allows it, who doesn't. So it's been more complex than we expected, but we are in the works. So.
Yeah, so again, stay tuned. I think that's going to happen, and it might be state specific off the bat. It might be only a half a dozen to a dozen states. So again, I can't stress to you, you know, we have these subject matter experts on our call here today across the country. We have a ton of subject matter experts. Stay in tune with them. If you can't find them, we'll show you a way you can get in touch with you. And if you're on this call, we'll definitely, before end of day tomorrow, have your account executive in touch with you. A couple other questions. Oscar, talk about transactions. Lisa talked about, you know, purchase, refinances. Talk about cash out. Talk about delayed financing also, Oscar, please.
So, you know, in today's market, we are seeing, you know, purchase has always been very strong on the DSCR investor cash flow program. Cash out is very strong on the DSCR investor cash flow. We actually see them combined sometimes because you have clients of yours that are going to want to cash out of their property to go purchase another property. And that's really important also to teach your realtor partners is how they can help their clients that are investors cash out and get of the equity that they have in that property now to go purchase more properties to keep growing their real estate portfolio. And one of the ways to do that is with delayed financing. You know, when investors buy a property cash, we're not part of the transaction, but we can be. And a lot of them don't know that they can get cash out with less than 6 months ownership of that property. So we can actually go up to the max LTV on the program using the lesser of the purchase price or appraised value, and they can continue to go buy properties. So it's a really strong product for that reason. Also, I always say whenever we see a cash out or refi, we generally see more than one transaction. So a loan officer once told me, this is a great product for me to get multiple loans from one investor. Because when you do work with an investor, they're probably going to have a pretty large portfolio. Many of them didn't know about debt service coverage ratio loans. Mm-hmm. Instead, they got hard money loans, and they're looking at rates above 10. So it's a no-brainer for them to want to refi. And those loans aren't meant to be long-term. They're normally less than 2 years. So it's something that they're going to have to do anyway. So it's a great way for you to market yourself and grow your pipeline really quickly by working with investors.
Yeah, Oscar, and usually those hard money loans have points up front too. So, and as Oscar mentioned, you know, those hard money lenders, and we'll talk a little bit about where to find these debt service income ratio borrowers, but you know, those hard money lenders don't want those loans on their warehouse lines that long. So we're going to show you a little bit there. A couple other questions.
I don't want to move on without mentioning the ease of you know, a refi, right? Because on a purchase, everything weighs on that appraisal and what comes back when you get the average, when the underwriter gets the average market rent back, right? And you can do your homework up front and you can research as that. You can get a pencil appraisal from a realtor. You can do your own due diligence and go on Zillow's estimate or renometer.com, and is another one that a lot of loan officers I work with use. But on refis, like we said, we can use the current lease. So it's super simple for you to pre-qualify that client. All you have to do is ask them for their current lease agreement. We're going to show you how you can get pricing later. You're going to jump on our non-QM quick quote. We already mentioned that to calculate DSCR, it's average market rent divided by, or your current lease on a refi divided by the PITI or PITIA. Jump on our quick quote. As long as you have insurance and taxes, you can put that information in together. You know exactly where you stand and how to structure your loan. So refis are extremely simple.
Yeah, Oscar, great thing. Sharon, yes, Oscar mentioned we're going to show you a tool that you can get rates, 24/7. Rachel, we are going to touch on foreign nationals because foreign nationals, the foreign national borrower falls under the debt service coverage ratio. So we're going to cover that in a little while. And Kathy, the timing is perfect. The training is perfect time, and I just submitted one for review yesterday, and it's a quick response. Yeah, this pre-qual, if everything's filled out correctly on the 1003, there should be no reason you don't get this pre-qual back, less than 24 hours, if not probably less than 12 hours. So we're going to talk about rates. That's a little bit. Kelsey, we'll have your AE contact you. It's more about construction loans and stuff like that. That might get into a little bit of. Lisa, maybe, you probably have a lot of short-term rentals in your area. Joshua wants to know, how are we going to calculate maybe the short-term rentals, with the appraisal and stuff up front?
Yeah, so again, we do require the 1007, and so the rents have to be listed on the 1007 form. And we expect to see just annual rents that are listed on that. And so that we're going to take, when we take the gross rents, obviously, whatever's listed there is the rents that are shown, but they do need to be annualized rents. So we're not considering any short-term rental comps as, for comparables for the rents. So they do have to qualify right now with, long-term rents.
Yeah. And Oscar, you touched a little bit on non-warrantable condos. Linda wants to know, you could probably recap with Linda, maybe the 2 or 3 things we usually get that make that property non-warrantable.
Yeah, high investor concentration. So the, let's say that there are 100 units in the condo project and 100 of them are non-owner occupied. So they're all individually owned by someone who will purchase it as an investment property. That's okay with us when it may not be okay for a traditional loan. The other one would be immaterial, litigation due to something that's immaterial, so not structural in nature. There isn't an issue with the roof of the condo project or the foundation of the condo project. That's something else that we can also consider. When there's a concentration, we mentioned short-term rentals. That's huge in that condo project. We're fine with it being part of the condo project. We can't use the short-term rental income for debt service coverage ratio, as Lisa mentioned. We use the annualized rent on the 1007.
And it's been a while, guys. So if not, we can get to Jack, maybe some more details. Lisa or Oscar, I'll throw this out to both of you because I'm not sure I remember it off the top of my head. So I'm taking a shot here. What about new construction? What percentage have to be closed and sold and completed and sold? Is it? And we might have to look at something here, but
I may have to pull it up too.
Sorry, guys. But Jack's been asking a lot of great questions. So Lisa's going to pull that up. So Lane's asking, Oscar, while Lisa's looking that up, Lane's asking about if the borrower, and Lisa touched on this earlier, if the borrower owns their property free and clear, right? But they want to purchase an investment property. Maybe go into a little bit more details, Oscar, about it has to look and smell like an investment property, right?
That's a really good question. It's really important. Yeah. So that's a key question that you need to ask your client. If your borrower, they own their property, their primary residence free and clear, that's okay. But you always want to ask them if they're a first-time investor, this is their first investment property that they're purchasing, or if you're comparing, you always want to compare whether or not they're going to be buying up. We don't allow that. You can't buy up. So compare their, let's say that they live in a single family home that's, 400,000. It's a 3-bedroom, 2-bathroom, and their next investment property is going to be a, 5-bedroom property that's over $1 million. That may not be something that we finance unless, of course, we can see in their real estate portfolio that they already own other investment properties that are similar in value. Because it's meant for investment purposes only. So it's meant to discourage people that are trying to use the program to purchase a primary residence.
Yeah, and Oscar, I think just want to make sure we're all clear on that. It's just, this is not for an owner-occupied property, right? And I know Lisa's still doing that, and I apologize, Lisa, for doing that.
No, it's okay.
This does have a prepayment penalty on it. The standard is a 3-year. And Jack's asking a question. So Jack, 30% of the loans we close don't meet our guidelines. So I think you're asking about someone living in Hawaii, maybe where home ownership is maybe a little bit harder to get. What we do get a lot of, though, Jack, is maybe someone living in New York City, where renting is, highly, a high percentage of it. Maybe they're looking to purchase an investment property somewhere else outside of New York City, possibly even further south. We'll entertain that. But as Oscar, really clearly mentioned, we still want to make sure it looks and smells and truly is an investment property, and not someone maybe even trying to buy a second home under the guise of, a no income, no employment. We want to protect everyone in the purchase, not only your license, but ours and everyone else's. So, but again, I wouldn't say no. I would just say let's look at the meat and potatoes of that deal and try and close it on your behalf. But one of the great things about our account executives, they're going to tell you no pretty quickly if it's a not make sense deal. So sorry, Lisa, I know we have you doing a lot of work here. So.
No, I'm good. I just found it. I just want to make sure I addressed the question. So it looks like if it's less than 25% sold and closed, it's not eligible. But basically, you just have LTV adjustments depending on how many are closed or sold. So they're looking for 90%, but that's to qualify for the max amount. So it just really depends on how many of the property have been, built and sold. They do want to see all the amenities finished though and completed for the property. So for the,
So thank you, Lisa, and I appreciate that. Yeah, so a lot of times if it's less than a certain percentage sold and closed, we might reduce our LTV exposure. But I believe, like you said, Lisa, 75% complete and sold will go up to the max LTV, correct?
Correct. Yep.
Thank you.
Yeah.
So I know we've got a couple other questions coming up here. We talked about prepayment penalty. Oscar, maybe talk about how we will allow, maybe we'll do better pricing for a longer prepayment penalty, and we can purchase the prepayment penalty out. Talk about that a little bit.
The standard prepayment penalty John mentioned is 3 years, but right now we have a rate incentive. If the borrower, generally borrowers using our investor cash flow program are going to be using, the reason is to purchase a property for long-term purposes, and they're going to be generating cash flow on it. So if the borrower would prefer a 4-year prepay, there's a rate incentive that we have for that. So that's really strong. And if they want to buy down the prepayment penalty, they can as well. So they can buy it down to 2, 1, or completely. To buy it down completely, the loan has to be borrower paid only. There are states where the prepayment penalties are completely restricted. So if you're in a state where they're not allowed, then they're not applied.
Well, thank you, Oscar. And Linda brings up a great question, because we're talking here, Lisa, like if this is only for savvy investors, is it also for a first-time investor?
Yeah, it really is. And this is a great time. This is a great opportunity for them to jump in, because you know, a lot of these people, maybe W-2 income people looking to just increase their, you know, their investments and their whatever. This is a great opportunity for them because we're not looking at debt to income ratios. You know, we're not having to, and we're coming up with the rents from this, you know, the 1007. This makes it easy for the first time investor to jump in. They've just got to own a primary residence. So really great experience for the new guys. It really
Yeah,
is.
and when we talk about the, you know, everyone can have their different opinions, but the best way to accumulate wealth, we all know, is through real estate, right? So yeah, so Linda, great question, kind of steering us back to, you know, whether it's a first time investor or a very, very seasoned investor.
Yeah.
And as Oscar mentioned, you know, a lot of these loans come in multi-packs. So you know, once they realize that this deal can be done with no income and no employment information, and just really assets and how the subject property qualifies for the program, it's one of the easy, as Oscar's mentioned, it's one of the easiest loans to close. So so let's talk. We've still got some questions coming in. Oscar, we talked about, you know, Anton's asking about the foreign national. We talk about foreign national debt service coverage ratio because it is on what we call internally our same matrix. So Oscar, just hit some highlights of foreign national and bring these up right now, and then we can kind of go into pricing engines and stuff like that. So
there's some key differences between, you know, just some things that are tweaked on the foreign national program specifically. You know, the loan amounts are the same, the minimum and the maximum, but the DSCR ratio has to be 1 to 1, not 1.15. So just 1 as opposed to 1.15. We do not go below 1. Okay, so that's a key difference. A very important documentation that you want to collect from your client up front, just to make sure that you meet the contract period, so your closing date. You want to make sure that the assets that they're going to be using have been sourced and seasoned for 60 days, and 30 of those days must be in a US FDIC insured bank account. So this can really impact your closing timeline. So something that you definitely want to collect upfront from your client. The reserve requirement is 12 months, and it must be in a US account. ACH auto payments are required. Our definition, this is a question that I get asked very often. What do you consider a foreign national? That would be a person who lives and works outside of the United States that wants to purchase an investment property in the United States. So they cannot reside in the United States. And another question that comes up after that is, can they sign? Do they have to fly in the US to sign? No, they can sign in the US embassy. The visas that were required are posted directly on the website. You can see them, and there are some countries that are on a visa waiver program that do not require it. Gift funds are not allowed on investment period, and the max loan to value is 70% on the foreign national program. We are not going to need any US credit period, so we won't be asking for a credit report. And like the DSCR loan, you won't be putting any income or employment on the 1003. So no income, employment, no DTI, no credit.
yeah, so Lisa, John's asking, how long does it usually typically take to close these loans? I mean,
within 30 days. I mean, obviously you're seeing a lot of stuff on LinkedIn, you know, CTC to 9, 10, 12. We're moving so quickly right now. It's such a great time to experience it.
yeah, and so Oscar, thank you for covering foreign national. Just some things I observe on this foreign national is with all this geopolitical unrest, right? You know, what's going on, a lot of foreigners are looking to invest, not only just in the US, but with the appreciation that we're seeing in US properties, right? And then some things to think about as you're trying to build your marketing plan for the rest of this year and into 2024. We see a lot of foreigners send their children to university here in the United States, right? So, you know, check your large universities. You know, when they're usually sending them here, they prefer maybe their child live in a a residence here in the US. We still call it a non-owner occupied investment property, but they usually would love to purchase that property for their children while they're going to that university. So think of a couple of other different ways to market yourself, or maybe, you know, as you're looking to, you know, buy lists, maybe it's around universities and stuff like that. So also, you know, property owners around university that rent to college students, think about, you know, refis, cash outs, and stuff like that. Lisa, anything in addition to foreign nationals?
On the foreign nationals, you meant?
Yeah, sorry. Yeah.
Not that I can think of. You know, I don't run across them as much as I'm sure Oscar does in the coastal areas.
Yeah.
Yeah. I mean, obviously they must live and work outside of the country. We get a lot of questions about what a foreign national is, and at least our consideration of a foreign national is someone who must live and work outside of the country. So we don't want anything related to the US, you know, on the application, etc.
So Danny asked a great question, Danny. So if they don't have a visa, and Oscar mentioned this, they have to be from one of those visa waiver countries, right? So that's Canada. Canadians, just a valid passport. You know, anyone in the UK, there's a list of those countries out there. So great question, Danny, but a valid passport and not a visa. The other question here, Danielle, I remember Danielle from last week's webinar. Thank you, Danielle, for attending, so I appreciate it. Non-permanent resident alien is different from our foreign national. We have do we have non-permanent resident? Permanent resident aliens, we
do.
We can do. No. Non-permanent resident aliens, we don't. But again, getting into details, contact your AE. We will definitely get those questions answered for you. This is being recorded. This will go out before end of day tomorrow for anyone who registered and anyone who attended. So thank you. And next month, we're definitely, just put a little public service announcement here. Next month, we'll be doing these webinars again. I don't have the schedule. They're usually every Thursday at 12 noon Central Standard Time. So I'm not sure which ones we'll do. We'll probably do bank statements and debt service coverage ratio again. And then where to find these borrowers. So let's, Oscar, I know we're going to talk, a lot of people have asked about rates. So let's talk about our non-quick quote tool, non-QM quick quote tool, sorry.
Absolutely. So as we always say, we like to say here, not a single loan closes here that doesn't start with this step. Okay, so this is going to be your first step to getting a rate quote. It's a really easy tool to use that's directly on our website. It's also easy to use when you're on the phone. Sometimes I'm at lunch and I get a phone call. All I have to do is open up Google Chrome and I have it bookmarked the non-QM quick quote, and I walk a loan officer through on getting a rate quote. So it's really functional on your cell phone too. So you just go to our website, the homepage. You have two places to click to choose the non-QM quick quote. It's either at the very top next to login or smack dab in the middle there with the check mark. And when you click on it, it's going to ask you to choose your channel type. And in this case, we're going to be choosing broker. And then you're going to enter the details of your scenario. So not a lot of questions. It's very simple. You type in your loan amount. You don't have to add any commas or periods. Then you want to select the credit bucket. You're going to enter the loan to value, housing history. In this case, this client has never had any lates over the last 24 months. Let's leave it as a 1-unit property. The transaction is going to default to purchase. Income documentation. This part's really important. It defaults to full doc, but we're doing DSCR, so you want to make sure to choose that from the drop down. Okay, otherwise you're going to get different pricing. The occupancy, we're going to change to investment. And the borrower type on DSCR loans, we can work with either a US citizen or permanent resident alien, or if you're pricing foreign national, then you're going to be choosing foreign national. Then the lock duration, Lisa mentioned our turn times are very quick right now, so we're getting loans closed within 30 days. The prepayment penalty that defaults is our standard 3-year. The escrow waiver, let's leave that as no. The interest only, if your client would prefer an interest only loan, if you want that pricing, all you have to do is select yes instead of no. If not, then you're getting our 30-year fixed pricing, and it's the compensation type is going to default to borrower paid comp. So as soon as you're done with that, you're going to see the rate. And if you want to see what your lender paid pricing would look like, all you have to do is change the compensation type to lender paid. You would select your LPC plan, and then you would it would give you the view of the lender paid rate stack. To view the rates, you click on view rates in blue, and it's going to show you pricing. Anything right now we're looking at borrower paid, so anything priced below 100 is a buy down of the rate. So it's going to be a cost. Anything above 100, you're giving your client back a credit, reducing their total closing costs. So this makes it extremely simple to structure your loan. And the next step that we talked about would be to send us the 1003 in credit for us to review. So at this point, you can choose any one of these rates. And what you're doing is you're just indicating to your AE essentially what rate to use. You're not locking in a rate at this point. Then you would click the blue select option button. Step two, sometimes you may get a blank screen like this. It's not actually blank. We just have to scroll up. It's gonna ask you to upload your MISMO 3.4. The next step is gonna ask you for the 1003 in PDF format anyway. You can skip this step by clicking next. When you get to step 3, this is important. Make sure to choose your account executive. So you'd either choose Lisa or me. If I'm your account executive, all you have to do is type O on your keyboard and it'll select me. Then you fill in your information and you're gonna upload, when you're done filling in your info, you're gonna upload the 1003 in credit report to the folders. Look for the ones with the red asterisk. You don't have to upload a 1008. When we scroll further down, it's going to ask you for bankruptcy type, the date the bankruptcy was discharged. We mentioned credit here, that would be 48 months. So anything within that, they would not qualify. So we're going to choose no, not applicable for these options. John mentioned the confessions box, right? This is it. This is the confessions box. This goes to your account executive. Anything that you need us to know, you can add here. It's for our eyes only, and then you would click on the submit button. This is really important. Just give it a couple seconds, wait for it to say successfully submitted, and when it does, that means that it's gone in, to your AE, and we get notified, all right? DSCR loans, within 24 hours, yeah. You know, so it's a really quick read to look through that 1003 in credit, but we do look at a lot of these. So give us a little bit of time. We'll get back to you within 24 hours. More than likely, you're going to be getting an email and a phone call from your account executive to go over the different requirements on the program.
Yeah, I've got a couple of questions in here. Luis is asking, you know, any exceptions? Luis, there, you know, 3 months ago, I'd say no. Right now, I would say nothing's off the table. Talk to your account executive. Make sure you have all your information together, like we talked about, a completed 1003, you know, an updated credit report. Just make sure you have those. If you're just starting a conversation, what ifs, we love scenarios, right? Oscar, Lisa, that gets our blood going. And so any scenarios, pick up the phone, call your AE. We love talking scenarios because they're going to ask you that second, third, maybe even fourth level question that's going to give them the aha moment. Maybe we got a shot here. So I would say, you know, we used to say, hey, call us if it falls out on agency. Well, we're going to talk about why you should market to these borrowers because, you know, there's not enough agency out there for everyone anymore. Let's face it, right? They're yep. saying origination industry in 2023 is going to be maybe 2 trillion, down from over 3 trillion. So we're going to help you guys, you know, if not maintain your business from 2022, but definitely grow your business in 2023. So I would just say, you know, let's get in touch with your account executive. Before we go into our marketing portal, I did want to share a slide here that shows you what this rental industry is growing to. You know, we mentioned it earlier on the call. A lot of your investors are self-employed. We know how that segment of the workforce continues to grow. Here's some statistics. 34% of the homes in the US are rental properties, and 70% of those are owned by individuals and not corporations. So do the math. This is, and Oscar said, this is a great way to build your pipeline. Not just build your pipeline, but build your pipeline quickly. I love that, Oscar. Thank you for sharing that. And then some people want to know, where do you find these investor cash flow borrowers, right? Realtors, you know, realtors have that Rolodex, Rolodex of investors. Sorry, right? And then
no one knows what those are anymore.
What's that?
No one knows what those are anymore anyway, so it's fine.
Okay, you're right. Your database. I'm sorry. Thanks. I made you look, you know, I made you look for something in the guidelines. Now you're going to get back at me. I like it. So go to other large banks and credit unions, because they're not doing these investor cash flow debt service coverage ratio loans. Hard money lenders, Oscar touched on that. CPA and tax preparers, everyone on this call is going to file their taxes in the next 60 to 90 days. Talk to your CPA. Why? Because CPA do a lot of tax returns for self-employed borrowers, and that's the fastest growing segment. Financial planners, wealth advisors, they probably will ask people to diversify their portfolio, and maybe that's with real estate. Real estate investing clubs. I had an AE in the Dallas-Fort Worth area tell me they did a Google search on real estate investment clubs and came up with 10 just in the DFW marketplace. Online communities, lead providers. I know August asked about where do you find these lead providers? You know, reach out to your account executive, they'll work with you. Social media, and now let's talk about social media, Lisa. You're gonna take us into our great marketing portal. We're gonna log in here. You do need login credentials to get to this. What Oscar just covered from the quick quote and the quick qual tool, you don't need login credentials. And Oscar, I'm going to throw an easy question over to you. Will we do a pre-qual on a TBD?
Absolutely. And the 1003 doesn't have to be signed by the loan officer, something that I mentioned when I went over the 1003. It does not need to be signed, okay? So you can send us the 1003 unsigned. And yes, property can be TBD.
Yep. So go ahead, Lisa. Let's start with flyers, Lisa.
Yeah. So the great part about this, about these flyers and all of the marketing tools that we have available is it's completely customizable. So there's no Angel Oak, signia on anything. It's all of your picture, your logo, everything else. But the great part is you guys have to market a million different things. We do one thing and one thing very well, and one it's non-QM. So we've created these already, customized for every one of the programs that we offer. They're updated based on our current guidelines, and so anything that's here is available for you to send to us to close and get underwritten and closed. But the great piece about this, you can send them digitally. Here it shows, as John's showing, you can add all of your information, including any disclosures, legal disclosures and stuff that you need to add there as well, like equal housing, all that kind of stuff. This is an example of one that looks so great. So once you put your information in, you'll see up top there's a download button. You can choose any of them, and it's going to automatically load your information onto any of our marketing flyers that we have. So once you put your stuff in, it's in there. So it's great. It's super quick. Again, you can do them digitally. You can have them printed, and it's a quick piece to be current with this particular marketing tool. And so these can be taken to your realtors, to builders, to any of your sphere of influence that you're talking to. And we have one actually, I still believe, customizable for the CPA as well. So cool, great stuff. We have a great marketing team. So lots of options there. And then we also offer not only for the flyers, but we also offer for social media posts. They're really great. And as now I love that they've given different options. So if you're looking for a certain look, we just don't have one look in particular, but you'll see for the bank statement program, for the investor cash flow programs, geared towards realtors. We've got all of these different social media posts. We even offer our deck that we use for presentations for you to actually, you can do a presentation. Of course, we always love to go in and do lunch and learns with you. For realtors, I know John's done a ton of realtor events lately, and all of us have been helping out loan officers. We're always happy to do that. But if you'd like to, you have this marketing stuff available here, and not only the presentation, but also there's a slide or a flyer to market the presentation to who you're setting it up for. So really nice quality stuff. Again, it's all updated to be current with our current guidelines. So.
Yeah, Lisa, I have been, I've been working with all the AEs and I'm telling you, it's the most powerful presentation you can do on behalf of your loan officer. And you don't have to, don't be nervous about, God, I got to be a subject matter expert. You see the quality of our subject matter experts, Oscar and Lisa, they know everything. Bring them along to you, whether it's via Zoom or in person. They don't say anything about Angel Oak. They just say they are one of your investors. And this is what this investor specializes in. And it is the most powerful presentation. We have a statistic, 9% of the loans we close on bank statements are realtors. So I say if you get 12 realtors in a room, the odds of getting one of their loans, and it happens every time, the odds of getting one of their loans is a very, very good chance and a high percentage. I did have someone yesterday, Lisa, at the trade show at the FAMP here in Miami brought up they love our whiteboard video. I love our whiteboard videos. And I was like, I haven't talked about them in a while. So I'm going to talk about it today because it was brought up to me yesterday. These are just generic whiteboard videos that talk about all of our programs, but they talk about them in such a generic, makes sense way. And it's a 1-minute video. You can post them, on any social media that just talks about a scenario and how we close that loan. So in addition to the flyers, social media posts, our whiteboard videos and the realtor presentation, you can get started today. And as Oscar mentioned, you can build a pipeline really, really quickly. So I think Carla was asking, how do you get login? Carla, I will reach out to you right after this call and make sure that I get you in contact with your, I'm gonna write this down right now too. So Oscar, anything with regards to marketing, I know you're a big realtor presentation guy. Just anything you want to share with marketing or just in closing?
Yeah, just because we talked about realtor presentations, it's something that us as AEs that we also do. I get calls all the time because a loan officer wants to present to a realtor or a group of realtors. I had a loan officer once tell me, Oscar, I don't think that I can walk in a realtor's office and not walk out with a loan when I present the DSCR program or the bank statement program, as you said. So very powerful tool, and use your AE. We're not charging you anything. It's completely free. You can set up the conversation. You can set up the presentation. Generally, the easiest way to do it would be through Zoom, which we also have, and we can send you the link so that you can invite everybody. This also cuts down your cost because you don't have to purchase any lunch for anybody to do a lunch and learn, right? And not to mention, you're going to grow your attendance because people don't have to think about all the traffic that they have to sit through to get to the office for this presentation. They can be heading in a completely different direction and listen in on the phone if they like. So they've always been very successful. Realtors get really excited because you're going to teach them how they can grow their commission in 2023.
Yeah.
Who would want to miss that presentation?
Yeah, I've done 3 in the last week. One LO/marketing manager has been able to pull in the 3 separate presentations we did. We had a combined of over probably 40 realtors that, and you saw the poll here. 84% have not originated a DSCR. Maybe the next question we ask is, who's heard of it? Because when we present to realtors, if I took a poll of just say 40, I would say 35% did not, 35 of them did not even know a bank statement loan was existent for a self-employed borrower. A DSCR, debt service coverage ratio, was for an investor. So you're educating and Lisa said this earlier, your sphere of influence, you are educating them, and they're going to bring those loans to you. So, and I think the loan officer we met with over this last week has had at least a half a dozen referrals from that. What turns into loans, it's still too early to tell, but activity, and that's what's going to create loans closed and houses sold. So you said anything in closing?
Yeah, aside from realtor presentations, listen, I know that there was a lot of information provided today. I encourage everybody to call your AE, reach out to them, email them, text them, to set up a presentation, either one-on-one or with your office. If you want to invite your teammates, we can go in depth again. We can over the debt service coverage ratio program or any other program that you want to become a specialist in. Kudos to everybody that joined this call. This was for you. It should help you offset any lost volume. Someone called me the other day and said, Oscar, I need you to, I need to set up a presentation with you on non-QM, because everybody's competing for the same borrower. Everybody's going after that Fannie Mae, Freddie Mac, and FHA borrower. I want to learn where I have less competition. And if you think about it, this program specifically, we dip into the hard money pool. We take a lot of those clients away from them. And I think that someone told me that the percentage of total loans that get closed, mortgage loans that get closed in general would be, hard money is about 10% of that. So you threw out a number that was like in the trillions. That's a huge opportunity. Mm-hmm. So you have all the marketing material. We're here to help you present and get the word out there that this program is there for investors.
Lisa, anything else in closing?
I did want to mention that in the quick qual, it's very important for us as AEs to make sure that your quick qual, once we send that pre-qualification to you, is right and accurate based on the information that we get. If we have concerns or questions or need exception of any kind, we have available to us our VP of Credit Risk up front. We take care of as much question as possible before we send you quick qual. So it's just good for you to know that once you go back to your borrower, you're very confident about, that what we offer is what we're going to present, what we present to you is what we're going to do. So I just thought I'd bring that up because people had questions about exceptions. We try to clear as much as we can out up front.
Yeah, that's super important, Lisa, and thank you for bringing that up. It is, we take our pre-quals around here, or what we call internally quick quals. We take those very seriously. We know the hard work it is out there to get a borrower and a referral source, and we understand and respect that relationship, and no one's going to do a pre-qual here without 100% confident that that's a loan we're going to close. So thank you very much, Lisa. So anything else?
No, I just want to say thank you. It's great. It's so exciting to see the potential of business that's out there. And if we can help in any way, we're all just as motivated to see these borrowers, in these loans and available for you guys. So it's awesome to see so many people on the call. It's great.
Yeah, Lisa, these borrowers that we do close loans for are great referral sources for the loans that close them. So it's really, truly. So I know we've gone a little past the top of the hour. I definitely want to thank Lisa. It's always a pleasure having you on our webinars, and Oscar, a pleasure, always. You guys, the wealth of information you guys bring is just second to none. So on behalf of everyone at Angel Oak, for those of you who have closed loans with us, thank you. For those who will, we look forward to earning your business, and stay tuned. We're going to please complete the survey if you can. We'll try to do things better. Next month, we'll probably do another deep dive into bank statements, debt service coverage ratio, and maybe even full doc. Hopefully we'll have some new enhancements for you guys by the end of next month. But thank you very much for spending this time with us. This is going to be recorded. Will be sent out before end of day today. Have a great afternoon. Thank you, everyone.